Michael Saylor's company just bought $2 billion worth of Bitcoin in a single week. But here's what almost nobody noticed: they didn't spend a dollar of their own money to do it. Strategy, the company formerly known as MicroStrategy, acquired 24,869 Bitcoin between May 12 and May 18, bringing their total holdings to 843,738 coins. That's more than 4% of Bitcoin's entire 21 million supply, now concentrated in the hands of one corporate treasury. But the story isn't the size of the purchase. It's how they paid for it. They used something called STRC, a perpetual preferred stock that trades at $100 per share and pays an 11.5% annual dividend in monthly cash. Investors hand Strategy $100. Strategy takes that cash and buys Bitcoin. Then Strategy pays those investors $11.50 per year, forever, or until the company decides to stop. No maturity date. No obligation to buy the shares back. Just a promise to keep paying dividends as long as Strategy exists. Here's the part that makes this a bet instead of a scam: Strategy is paying 11.5% to borrow that money. If Bitcoin doesn't appreciate faster than 11.5% per year, the company is losing. But if it does, and Saylor clearly believes it will, then Strategy pockets the difference. Every dollar of appreciation above that 11.5% threshold goes to the common shareholders. The preferred stockholders get their fixed yield. The common shareholders get the upside. And crucially, issuing preferred stock doesn't dilute the common shareholders the way issuing more common shares would. Preferred stock is a separate class. It doesn't give investors voting rights. It doesn't cut up the existing equity pie into smaller slices. It's more like taking out a loan, except the interest rate floats and the principal never has to be repaid. For common shareholders, it's almost invisible until the Bitcoin appreciates, and suddenly their slice of the company is worth vastly more. Strategy has been doing this for months. The company launched STRC in July 2025 with a 9% dividend yield. That rate has since climbed to 11.5%, rising as Bitcoin's volatility made the bet riskier. But the appetite from investors hasn't wavered. Every time Strategy sells STRC shares, they turn around and buy more Bitcoin. The purchases are predictable now, so predictable that traders have started front-running the mid-month ex-dividend dates, knowing Strategy will buy again. The scale is staggering. Strategy's 843,738 Bitcoin cost them roughly $63.9 billion to acquire, at an average price of $75,700 per coin. At current prices, they're sitting on about $1.4 billion in paper gains. But the real story isn't the profit, it's the mechanism. Saylor has built a machine that lets him accumulate Bitcoin using other people's money, while paying them a fixed yield and keeping the volatile upside for his shareholders. It's leverage, but dressed up as equity. And it's working. At least for now. The company has publicly stated it wants to own 1 million Bitcoin by the end of 2026. That means acquiring another 156,000 coins in the next 7 months, roughly $12.6 billion at today's prices. If STRC keeps attracting buyers, Strategy can hit that target without ever touching its balance sheet cash. But the machine only works if Bitcoin keeps going up. If it stalls, or worse, drops, then Strategy is paying 11.5% on billions of dollars for an asset that isn't appreciating. The preferred shareholders still get their dividends. The common shareholders eat the loss. And unlike a bond, there's no maturity date where Strategy has to give the money back. The dividend obligation just keeps running, month after month, until the company either redeems the shares or collapses. Saylor is betting that Bitcoin will outpace an 11.5% annual cost of capital for years, maybe decades. If he's right, this will look like the most elegant financial engineering in corporate history. If he's wrong, it will look like the most expensive loan nobody ever had to repay.